This is just the latest installment in our webinar series, Restaurant Finance 401. Throughout the decades of work that we've done with restaurants, we found that when we're able to impart our knowledge on our clients and their teams, they are able to do better for their restaurants and do better for their careers in general. And so we started this webinar series as a way to educate our clients. Today's topic is actually a suggested topic from one of our clients. We'll be going over balance sheet essentially 102. So really an in-depth understanding of how to read, how to analyze your balance sheet. If there are any terms that you don't understand, or if you need to go back to basics a little bit, we sent out a link, and I'll link it here as well, to our balance sheet 101 video that gives you kind of like those core fundamentals. If during the webinar there's something that you don't understand, feel free to drop that in the chat and we can just go ahead and respond to you there. But if you have any bigger questions, which I hope you all do, we will be having a Q&A session after the presentation. But first I will go into our agenda. So on the agenda today, we are going to first start off by talking about kind of an overview of the balance sheet, especially as it relates to GAAP practices. Then we'll talk about the relationship between the P&L and the balance sheet. And then we're going to actually analyze a balance sheet in depth with you all, discuss further about assets, liabilities, and equity, give you some pro tips about analysis for each section. Then we'll discuss the red flags and green flags that you might find in a restaurant balance sheet, just so that you know as you're reviewing your own. We'll talk about some important KPIs and debt ratios that you should keep in mind as you're reviewing your business or another business. And then, as I mentioned, we'll go into the Q&A. Our speakers today are Kiran Talreja and Ruhel Ahmed. And so without further ado, I will let them take it away.
Hi everyone, good afternoon. I'm Kiran Talreja. I'm a chartered accountant based out of India. I moved to US and started working with Paperchase. It has been a fun ride. I currently work as a senior accounts manager at Paperchase. I work with clients based out of Washington, D.C., Virginia, New York, and Arizona currently. We cater to all types of restaurant, maybe it is a food truck, maybe it's a small cafe, or a Michelin star restaurant. We got you. Today, I'll be presenting some of my learnings from the balance sheet along with my mentor and co-host for today, Ruhel Ahmed. Ruhel, over to you.
Thank you, Kiran. Hi, everyone. My name is Ruhel. I've been at Paperchase for the last 8 years. I'm a senior accounts manager here. I oversee, of course, a lot of clients that Kiran mentioned. We scale from QSR to fine dining to franchisees and franchisors, etc. Right? We're excited to be here. Thank you all for attending. And let's get the show started, Kiran.
If you are already a client working with us, you would know that we deliver 3 key reports every month, every week for your review. Starting is with the P&L report, the cash flow report, and balance sheet. Today, we'll be discussing more about balance sheet, but I'm sure you look at your P&Ls, you look at your cash flow statement, and do a health check of your entire business while carrying the burden of running such a labor-intensive and food-intensive business that you all work in. Typically, a balance sheet has 3 key elements: assets, liabilities, and equity. Asset is anything what the company owns, liabilities is anything that the company owes, and equity is anything that is left over. Just to give you a little more background, asset will be anything that you purchased, any furniture, any cash, any debtors, any accounts receivable that you have is your asset. Liability is anything that you owe and you are due to pay. It can be to your vendors, it can be to the government, it can be to loan, any party that you pay to is your liability that you ought to pay. And equity is all of your members' contribution, all of the distributions, all of the retained earnings that you have in business. We'll be talking about each and every term, and at Paperchase, how do we prepare a reconciliation of each and every balance sheet item that reflects in your business is what we'll be talking about in detail. As the name suggests, balance sheet has to balance. On next slide, my friend Mitchell will show you a fundamental accounting equation, which is all assets must equal to liabilities and equity altogether. A balance sheet has to balance. If any time you receive a balance sheet that doesn't balance, you have to send it right away back because that is not the correct representation of the business. As I said, we'll be discussing all the three elements, and maybe you already got a chance to look at the 101 video that we created with the team for your easy reference. Asset is anything basically what you owe. Anything we classify assets into current assets and non-current assets based on their liquidity. Any cash that you have readily available to purchase anything that is your current asset. Any accounts receivable that can be easily liquidated is again your current asset. Non-current asset, due to its nature, is non-current. That is, it takes much more time to liquidate for you to use that cash. For example, if you purchase your equipment in your kitchen that you cannot sell readily and make cash out of it, that will be a non-current asset. Liability, again, depending on the nature of its due, will be a non-current or current. Any accounts payable balances that you have that you might be getting already as a report from Paperchase on a weekly basis, that here are your 10 vendors, and based on the due dates and cash availability, you can approve and we make payments on your behalf. That's the entire portion that we'll be discussing. And how do we look at the aging to make sure that we are paying all the vendors in time and we don't get into trouble, because vendors keeps the business going. Receiving goods keeps the business going. Loans is any additional capital support that you might get from banks, that you might get from friends and family, or that you might get from government. For example, during COVID, a lot of the clients that we work with received SBA EIDL loans to make sure that the business has enough funding. And equity is the section that you will get funds, maybe from your friends and family, maybe from crowdfunding, maybe from institutional investors. All of the money put in the business is basically the equity section that we'll be talking about. You might already look at the P&L every month, but maybe you are not looking at the balance sheet. So that's why we are trying to cover each and every aspect of what a balance sheet account would look like. A lot of time we do get question, what is the fundamental difference between a P&L and a balance sheet and how are they related? P&L is basically like a movie that is capturing your day-to-day progress, and you might look it for a week or for a month. So it is basically aggregation of all the events that happen for 30 days for a week. On the contrary, balance sheet is like a snapshot or a picture in your gallery. It is not the same each day. If I move right, I have another day, I have another bank position, I have another balance sheet position. If I go a day earlier, that might also change. And that is also a key um, reason why balance sheet is a little inflexible. Most of the time, our clients do reach out back to us saying that, hey, can you move this to P&L? Can you move this to balance sheet? A lot of balance sheet items we cannot alter very easily just because of the nature of items that are there on the balance sheet. We will be going over a standard balance sheet and how we prepare a reconciliation. But for example, your bank balance as of 12/31 is $100,000. There is nothing that you or your accountants can change. As of 12/31, if your inventory is $50,000, there is nothing that you could change. Just because of nature of the items or accounts categorized on balance sheet, it is a little bit more inflexible in terms of movement, in terms of adjustments that we make. Moving on to the next section, we'll deep dive into assets, liability, equity, and we'll be looking at each category's red flags and what can you do to make sure that your asset balance is up to date, is looking fine. What can you do to make your liability accounts are up to date and looking fine, and similar with equity. Then we'll also be covering a few ratios. I'll share my screen and we can go over a standard balance sheet and a standard balance sheet reconciliation of how we prepared this as a part of our internal audit at Paperchase. Um, any of the panelists, can you confirm if my screen is visible?
It's
Yes.
not.
We can see you.
Okay, thank you so much. So today we'll be going over balance sheet of Cafe Kiran. We have two owners in Cafe Kiran that sells very good coffee, very good liquor, and a lot of good food. We'll be looking at a standard balance sheet and a balance sheet reconciliation as of September 30 in this case, but you might also be gearing up for the year end and maybe you already started looking at your balance sheet as of December 31, 2024. As we discussed about three main components, we'll start with the first one, that is assets. Anything that we own, anything that the business owns, current asset, non-current assets, majorly the plant, property, and equipment that we'll be talking about is the non-current asset for a restaurant typically. Moving on to current assets, we have three major items here: cash and banks, accounts receivable, and any other we usually try to club in between the other current assets unless you specifically want us to categorize it as a separate line item on the balance sheet. A lot of our clients do have just operations account and taxes account and payroll account. A lot of them do like to separate the bank's account for different use, so they have funds earmarked. In this case, the example that we are talking about has multiple bank accounts where they use one for operations, one for payroll, one for specifically food and beverage payments, so their day-to-day business is not hampered, one for the money market, and another one is for cash. How do we look at these balances and make sure that they are accurate as of this date? How do we take an independent confirmation is the uh, uh, aim that we are trying to achieve here. If I am trying to look at this bank balance, what I would typically do is I would refer back to the work paper prepared and also a reconciliation, because most of the times you would see that the bank balance on your um, PDF bank statement generated is not equal to the balance that you usually have on balance sheet. That is because of a lot of unreconciled payment and unreconciled receipts. Let's say you cut a check for your accountants that accountants have not deposited and cleared yet. So in your books, the payment has already gone, but the accountants have not received it or not cashed it yet. And n number of reasons like this would cause a difference in the balance as per your books, as per your statement. What we typically prepare to reconcile this is called a bank reconciliation statement. As your accountants, we would prepare a bank reconciliation report for you. And while verification or doing this internal audit, we would also look at your bank statement, attach a PDF for our reference, and make sure that the balance that we have on balance sheet is up to date. Why looking at bank balances or cash balances is important from a restaurant point of view is, again, that gives you an idea of how much runway do you have. If especially in the slower months, or if you are a loss making business as of now, maybe you just started or you expanded, checking your cash balances, having your cash forecast is most important to make sure that you have enough cash to cover all the coming expenses, as well as you have earmarked funds for any emergencies that might hit your way. Another key question that we mostly get asked is about the petty cash or cash reconciliation. A lot of restaurants do collect cash tips. Why Paperchase or how Paperchase comes in here is that we do a cash reconciliation on your behalf, making sure all the cash punched on POS is reconciled and deposited into your bank, as well as all the cash tips punched is being reconciled as a part of tips reconciliation, and employees are paid for all tips collected on your behalf. Then moving on to the next segment, accounts receivable. This is a major chunk of your business, and typically accounts receivable means any vendor or any customer that is going to pay you money. It can be in terms of house account, it can be Amex, it can be Visa, it can be MasterCard, it can be any vendor that has not paid you yet but is going to pay you very soon. Making sure that you have all of your invoices, all of your customers paid up currently gives you enough cash on hand and make sure that your DSO is at the minimum. What we do as a part of our balance sheet reconciliation is we make sure that any merchants that have to process payments receive the payment in time, as well as any cash that is receivable or to be deposited in the bank is deposited in time, minimizing the chances of any pilferage. And we prepare a reconciliation day by day. This is a standard work paper that we prepare for each and every client, making sure if there are any refunds, any chargebacks that are recorded correctly. If there is any short or extra, we can reach out to the merchant and ask why was it short deposited. And similarly for cash, if there is anything that we don't find, anything that was not deposited in time, a question is raised to you as a weekly query or in your calls that you do with the team. Here we would like to do a quick poll just to understand any pain points that you might experience with AR. Michelle, do you mind launching the poll?
All right, so we have a poll up on screen. What is your biggest AR pain point? Cash reconciliation, third-party vendors, chargebacks, all of the above, or other? So let us know what you guys think. What's the thing that is driving you the most crazy? What part of AR do you not really understand in your balance sheet also? So far, we have 2 votes for chargebacks, 1 vote for third-party vendors. Give everybody another couple seconds to answer the poll, and then we'll get right back into it. So far, it is looking like chargebacks with 75% of the vote are the most tedious, and then in second place is third-party vendors. No votes for the other options.
Okay,
All
thank you
right,
for
we'll
answering
get
and
back to Kieran.
participating in the poll. Yep, I can totally understand how painful it can be to reconcile all the third parties, including Uber Eats, DoorDash, and especially if you run into any issues, following up with them, making sure that we are paid in time. As well as on the chargebacks, I think time sensitivity is what makes it even more complex because you have a limited time to dispute the transaction, submit all the work papers, and challenge it. Otherwise, you lose the money. So, can really relate to why it is so challenging. Okay, coming back to our other assets, and we'll start with inventories now. So inventory is a key part. I'm sure you all do your inventories on a weekly basis or on a monthly basis, as you have discussed with your operations staff and your accountants. How does inventory affect your balances is that if you have too much inventory, if you have too less inventory, all of that is going to be a problem. Deciding on what is an appropriate level of inventory, what should be the minimum order of inventory when you place in the orders, what is the lead time to get those orders, making sure you do not pile up on so much inventory that affects your cash balances negatively, that affects your quality ultimately, because having stale or expired inventory is not just losing on dollar value, a few dollar values here that you invested to purchase the inventory, but also it reflects on the quality and ultimately the customer satisfaction, which is the last thing that we want after putting in all the efforts of running a restaurant. Typically, we advise all the clients to look at the inventory aging report, depending on if their inventory values have been climbing up and up and up. We understand there are busy seasons and we need to be stocked very well for a few days, for a few events. But then, having said that, other than that, inventory should be streamlined and you should know what is the balanced inventory level. Here at Paperchase, we do take all the inventory reports received from the clients, look at it if there is any price variation, if there is any quantity variation, and try to rule out any possibility of typo errors punched in by your team while doing the inventory. Because again, wherever humans are involved, there is a chance of error. So we do look at that and then book the inventories. This also links back to the analysis of COGS on your P&L, because anytime you are surprised looking at your high COGS for the month, COGS is basically cost of goods sold. If it is very high or very low, that can also be a key component based on your inventory, because basically it's opening inventory plus purchases and minus closing inventory. So having your inventory numbers accurate and timely punched in is very, very important for you to analyze the results, not only just on the balance sheet perspective, but also from profitability perspective to have a holistic health check of your business. Moving on to the prepaid expenses, a lot of you might not know what are prepaid expenses or not know how to verify or vouch for the prepaid expenses. Prepaid, as the name suggests, is any expense, any invoice that you have paid in advance that you could have paid later given chance. We do prepare a prepaid schedule here at Paperchase for you to analyze how it what is the number signifying is basically that you could have delayed it, and this is extra cash that you have blocked right now that could have been used in other places in the operation to make the business much more viable. A quick example of prepaid schedule is there are a few licenses that you have to pay in advance. The validity for license is 12 months. You don't have an option, but you pay. It should not affect your profitability for just one period because this is going to span over next 12 months or next 18 months. So we try to split that cost between the relevant months of its validity, making sure that the burden is not entirely on one period. Another common example that we see in almost all our clients is insurances cost. We should definitely try going back to the insurance carrier and seeing if we can make a monthly payment. If not, and if we have to pay the premium upfront, what we try to do, at least from the recording perspective, is we try to split the cost in relevant months so it doesn't affect the profitability of each month when you are analyzing, although it resulted in a cash flow that went out in one go that could have gone in pieces. Moving on to the non-current asset, that is typically of the nature not very liquid, not very readily sellable, but an important part for getting the business up and running. There is always an option of equipment financing, but a lot of our clients do prefer to buy their own furniture, buy their own equipment instead of leasing or renting it out. What we do at Paperchase is we do prepare a fixed asset schedule and record each and every item that was purchased with an invoice backup, mostly in the pre-opening phase when the restaurant experiences a heavy cash outflow and a lot of purchases of plant property and equipment. This is the key time when the fixed asset schedule is prepared, but we keep on regularly maintaining and updating it. There is a very common question of what should be categorized as repair and maintenance on P&L and what can be capitalized on the balance sheet. It will definitely depend on the nature of expense made as well as the monetary value. At Paperchase, we do consider the minimum value to be 2,500. Above that, we try and capitalize it on the balance sheet as a part of current fixed asset. If it is lower than that, we could make a choice of splitting it between the months, or we could make a choice of just expensing it out in one period, depending on how comfortable you are with that number hitting in that month. Non-current assets, fixed assets can also be tangible, intangible. A lot of times you would have goodwill, you would have your website, you would have your social media handles that have much more value that you can nominate into dollar values. And this also is subject to the depreciation and amortization. Depreciation and amortization, again, is not an expense that you can control. It is by nature. We have to take a section of your profit out of it. It's nothing that you can control within the four-wall EBITDA, as we call in accounting terms. It has to be incurred. We can do it for you every month, or we can do it just in one go at the year end, depending on how comfortable you are and what is the CPA recommendation that you work with. These were a few things that I wanted to cover about the assets, but I'll hand it back to my mentor and co-host Ruhel for summarizing and telling us a little more about red flags when we look at the asset or analyze asset.
Yeah, thank you for that, Kiran. So I just want to quickly touch bases on a couple of the red flags while looking at the balance sheet entirely, but especially when you're focused on the asset side of it, right? So the assets, like Kiran mentioned, the long-term assets, the short-term assets shows you how, liquidating the company is and how quickly you can get cash out of it. So a couple of things we all want to be definitely alert on, and especially us accountants here at Paperchase, we try to look out for those as well. Is one is high accounts receivable. You never want to carry a high AR balance because it's obviously cash that's outstanding, owed to you. You want to make sure that you have that collected and it's coming in real time, right? Usually with the merchants, when it comes to Visa, MasterCard, Amex, that's not an issue. For the most part, like POS, such as Toast, Squares, they process their daily receivables pretty much on a day, a couple of days delay essentially. So anything that's owed in today would be, all the sales for today would be coming in the next day or two, right? So usually we don't run into issues with the merchants. What we do run into issues with is the third-party receivables. Sometimes they take a while to get those payments in. Second is making sure that those are reconciled. Usually there are some adjustments, cancel orders and things of that nature. So we often have, run-ins with them to making sure while we make sure that we are obviously reconciling those accounts. Another element of it is the cash receivables. That becomes an issue for a lot of our clients because cash is just cash. It's laying out there in the restaurant, right? Whether it be inside the safe or inside the cash drawers, it's there and it's available to pretty much everyone. So what we need to do is a couple of things that we suggest to our clients is making sure that you're making frequent deposits, sometimes once or maybe even twice a week, just to make sure that whatever cash is being received at the restaurant is going into the banks immediately. So this way you don't have to worry about, manager going out to the grocery store and buying something from petty cash XYZ, right? Also, what happens a lot of the times is petty cash is being used up because there's cash balances at the restaurant that is pretty much available to the managers where they're now having to make those purchases. But if they don't have that cash at the restaurant, they'll definitely try to order in advance. And usually we run into issues with the reconciliation of the petty cash because cash is missing and we don't have the expenses for it, then it can run into severe issues down the line at some point. So that is definitely a pain point, and I know a lot of the poll questions. Some of you guys did say, chargebacks was an issue, but that usually, we have to rely on the managers to be able to send those documents back to the merchants on a timely fashion. So just making sure that documenting of those receipts, the customer signed receipts, is definitely something that has to happen pretty much on a nightly basis. Another area of focus is inventory. Inventory is something that it gets overlooked a lot of the times, not so much for fine dining establishment, but our mid-sized clients and QSRs. The reason because I mean everyone should definitely take a monthly inventory. That is something that we recommend. However, we understand inventory is a time-consuming, labor-consuming process, so you may not be able to get to it at least on a weekly basis. But we definitely recommend having inventory done pretty much on a monthly basis, especially for your big ticket items, right? Like, if you have a high inventory in wine, liquor, etc., you definitely want to take inventory of that real time, just so you know how much you're working with. At the same time, we always advise clients to not to buy in bulk and buy what you need. It's easier said than done, but at the same time, understanding how it impacts the overall business health of it, how it impacts the cash flow side of it as well, right? I know ordering in bulk can be time, money saving, and you may save a few dollars by ordering in bulk, but at the same time, it may lead to, wastage or something being broken, also theft for that matter, right? So just making sure that staying on top of inventory can go a long way for sure. Also making sure that inventory amount is consistent. They should not be, you should not have $30,000 in inventory in 1 month and the next month is 60,000, right? How do you justify that additional purchase? That's the cash that could have been used for something else, right? So just making sure that you're keeping an eye on it real time is definitely severely important. And the third one here is low cash and bank balance, especially this time of the year coming out of the holiday period when things are slow. Everybody's trying to plan ahead, project cash flow, get into the 2025 budgets, etc. Budgets should really be created for the following year towards Q4 of prior year. So this way you know what you're working with, especially Q1 and Q2, given the fact that those will probably be somewhat of a slow season, especially Q1. And then, of course, we know after at the end of Q1, business sort of picks up a little bit. However, at the end of Q2, when summer hits and kids are out of school and everyone is planning their vacations, we do take it, and the restaurant industry does slow down a bit, right? So just understanding cash flow, making sure that you're preparing for anything that could happen. Emergencies are always happening. Wintertime, a water pipe can burst, and that can lead to a closure of the restaurant for a couple of days, right? You still have to pay your utilities, you still have to pay your rent, you still have to pay some of your salaried employees and whatnot. So just making sure that cash is being maintained. And also, obviously, you're stretching every single dollar. That can go a long way. And that also is a good time for you to go back and revisit some of the vendor terms. Like if you're working with Chef's Warehouse and you have net 14, now would be a good time to go back and say, hey, listen, I have X amount in purchases from you guys. We want to extend our term from net 14 to now net 21 or even net 28. That allows you to have additional 2 weeks of, to be have to pay those invoices, and it can stretch a couple of days. Last but not least is the high prepaid expense, and Kieran sort of touched up on this earlier as well. Don't pay for something you don't have to unless you absolutely have to, right? But that's not saying that you should stretch every single bill, if you should stretch every single insurance bill and what payment, etc. We're just saying that do not pay everything out in advance. You may think saving a couple of $100 is a good thing. However, when you look at it, if you're purchasing a policy for 25 and $30,000, is saving that $200 or $300 really worth it, right? Especially given the fact that there will be times like this when it's a slow season and you just have to stretch every single dollar that you have in the bank. So making sure that the prepaid balances is not something that's too extensive and is kept to a bare minimum is definitely a good practice for sure. With that being said, I'll give it back to Kieran to go over liabilities.
Yep. Thank you for summarizing that so well, Ruhel. I'll go back to the work paper and we'll start talking about liabilities. Liability is anything owed as a debt or an obligation that the business has to pay. Only difference between current liability and non-current liability is that anything that you owe that needs to be paid, that is an obligation to be paid within the normal operating cycle or within 1 year of business operation is current liabilities. And anything that we classify as non-current liabilities, basically that is outside of normal business operation cycle or more than a year. Most common current liability that you might have seen getting a report already from your AP analyst or AP people that work at Paperchase is the accounts payable. It is basically all the vendor payments that we made for any food, service, beverages purchased. How do we take a quick look or how do we make sure that the balance is up to date and accurate? Most important question as a business owner, as a restaurant owner, that I would ask is that am I able to pay all my vendors within the net terms that they have said? Am I able to pay them in 60 days, 90 days? But how do I do that? So we do have a AR AP aging report that we prepare and look at every week, every month, and we can do it every call with you. It's basically looking at the vendor wise balance, which invoice is open. Why have I not paid Ecolab? Why have I not paid Baldur? Do I have a few more days that I can delay the payment on? As well as the part of the balance sheet reconciliation or the internal audit that we do look at vendor wise each invoice that is open. Let's say if this aged only 4 days because I'm looking at the balance sheet reconciliation as of 9:30, I can just put a comment that it was already paid in October while I was preparing that, and that is good enough for me to go ahead. There might be a lot of debit balances that you see on the AP aging while you review the AP. There can be a few different reasons. One of the most common one is that we have not received the invoice backup. If we are pending invoice backup, we typically wait and follow up for the invoice from the vendor or from you to make sure that we have our records up to date. Another reason of having a debit balance here or a negative balance here is that we do have actual credit open with that vendor. Analyzing this AP report will give you a very fair idea of how much cash I'm needing on a weekly basis, how much cash I'm needing on a monthly basis to make sure all my vendors are paid in time. If you are a restaurant owner, you are already aware that SLA is in effect in New York based clients. Any liquor payment that you delay even by 1 day, it doesn't matter if it is $10, $50, $100, you cannot order in more goods. So having this vendor payment sorted out and paid them in time is very, very important to avoid any 911 situations. Recommendation is using fintech here. If you are already not using fintech, please reach out to the teams that you work with and they can help you set up fintech that would try and avoid any chances of having issues with the liquor vendors, and we can make sure that we also do a double check and have them paid in time. Coming to all the other current liabilities, again, classification is subject to how you prefer it, but typically we classify into accounts payable and all the other current liabilities because there are a lot of reconciliations that we do for tips, for service charges, for net wages payable, for any PTO accruals. So that's why all of that is right now clubbed in my balance sheet under other current liabilities. Starting with a very key other current liability that is accrued liability. It's the sister of prepaid expenses. Anything that you have not paid yet, but it's already due, is your accrued liability. Any percentage rent that you have not been paying your landlord right now, but you have to pay because we have already made that income. A lot of our clients have this clause as a part of their lease agreement of giving an additional percentage rent over and above the base rent if they are doing good. We do accrue for it every month once the sales is finalized, once the sales is sent for compliance perspective, and we do make this accrual so it is not one hit as of the date when you have to pay. You might have to pay it once a year, you might have to pay it once a quarter, but that should be consistent in your P&Ls so that you have a right picture of your profitability. And you can also keep aside funds to make sure that we have enough funds to cover this payment when it's actually due. Another key example of accrued uh, liabilities here is your water bills. Most of the landlords would send you water bills once a quarter, once a year, and then there is additional expense hitting your P&L that changes the entire picture. So every expense that we have not received invoice for, every expense that you know that you have to pay now or later, 2 days later, 2 months later, is a part of the accrued liabilities on our balance sheet. There are miscellaneous reconciliations that we do, and we do have standard work papers for net wages payable, for tips payable, for any gift cards that you deal in. Most of our clients do operate with electronic as well as paper gift cards. If it is already linked to your POS, let's say if you are using POS Toast, it already gives you a summary by each gift card: when was it issued, when what is redeemed, what is the dollar value left in wallet. Everything is there, but we still do an additional gift card check to make sure that the balance is up to date on your balance sheet and you know what money we have collected, and we need to honor that whenever a customer comes in with that gift card value. Another very restaurant specific thing here is the events and PDR. I'm sure all of you are waiting to hear this. How do we make sure that all the events are reconciled in time? A lot of you might have questioned that I received a deposit for a birthday party, let's say $1,000. Should it be part of my revenue and should it be part of my profitability on the day I received it, or it should be a part when the event actually happened? So the answer to it is going back to the US GAAP principle of revenue recognition. Revenue can only be recognized once it is confirmed that you have earned that revenue. Any events, any reservation, let's say you have a Resi uh, reservation platform connection to your POS, that can also be recognized as revenue once the reservation is honored, or we book that as a no-show fees on the P&L if the guest is not able to come in. But all of that needs to happen on the day of that actual event. What we do at Paperchase is we do try to record each and every event by the date of event, name of event, and make sure that as of 9:30, when I'm reviewing the balance sheet as of 9:30, I do go back, look at all the event dates for these deposits, and make sure that if there was any deposit for August or September, I go back, work with the events team, work with the operations team, and find out if that event was rescheduled or it was a no-show, or we reached out back that, hey, this is the credit that we are offering, do you want to come in and do the event again? Whatever is the decision, from accounting perspective, we do need to make sure that it is accounted for rightly, and we know what we owe, and we might have to honor to our customers who just paid a deposit here. From restaurant perspective, again, this can be a changing point. If you look at all the no-show or all the people that were not able to come in, you might have your manager reach out to them and extend an offer for them to come in. Once they decide to come in, that is more and more revenue for the business. So again, just taking time to look at all these balances and seeing will give you more and more insight or more and more ideas away from the day-to-day hassle of operations which you are already in and doing the daily grind. From compliance perspective, there are two key things on the balance sheet. One is the sales tax payable that we'll be talking about, and another one is the liability for uncleared checks. Sales tax payable, I would say, is very important because each and every dollar that we are collecting as sales tax should be earmarked and kept for utilization in payment of sales tax. A lot of times we have seen this happening that if our client is a quarterly filer, they collected money for 3 months and then suddenly when they have to make a payment, they do not have enough funds just because we did not earmark the funds. Key recommendation here would be to have a sales tax account separately so that you can have the funds earmarked and you don't touch that fund, or you can plan for it if you want to use that funds in 2 months, but make sure on the day of payment you have funds available for the government to avoid any issues, any penalties, any notices. Liability for unclear checks is a state-wise requirement. Let's say if my client is based out of New York or DC, there are different due dates where by law you are mandated to report the name. on check, the amount on check, when was it presented, and you make enough efforts to reach out back to that employee or vendor. The intention being that when I cut a check from my books, I already booked it as an expense and I took it as a deduction while filing my returns. But that employee or that vendor never encashed that check. So they are entitled to get this money, or we are entitled not to get the deduction. As a compliance perspective, we do maintain these details by each employee or by each vendor name with their employee code, with their check number, with their amount, and when was this check originally issued. By law, we are required to send a certified mail back to these people, making sure that they were tried to contact and we tried to make an effort to give them this money back. If we are still not able to get a hold of them, or if we do not have the correct email ID or address on file, this entire detail needs to be filed to New York State or DC State, or check for your state that you operate in. It needs to be filed to government, and then if they reach out to you anytime later than 3 years, then they can reach back to government and government can pay them this money if they realize someday that they were missing a check. Another key thing on balance sheet is your intercompany accounts if you operate in multiple locations. There can be transfer of food, there can be transfer of labor, there can be transfer of cash as and when needed. So intercompany account is basically a reconciliation or a reflection of interlocation movement or intercompany's movement between your operations. These were a few current assets that we usually see on our client's balance sheet. And then coming to the non-current part, which is not very liquid, not due in like 12 months, not due immediately, but eventually you have to plan and set aside money for them. Most common ones that we see are the loans. It can be bank loan, it can be assistance from government, it can be SBA, EIDL, for example. Loan is different from grant. Grant is any money that you received and you don't have to pay it back. Loan is anything that you receive. There might be a deferment period that you don't have to pay for initial 2 years, but you still ought to pay that interest or repay that principal amount received. How much loan is enough loan? How do we know that answer? If $1 million is enough, if $5 million is enough, should I raise more debt? Should I liquidate my equity? How do we make that decision? There is a key metrics that we mostly use. That's the debt equity ratio that gives you a fair idea of how much more debt I can take against the equity that I have invested in my business. Again, it is very individual specific decision. Some clients like to go more riskier than the others. Some try to be very conservative, but you can look at this metrics and maybe have a fair idea of should I raise another round with my friends and family or should I go for another loan. Having the loan amortization schedule figure out will also help you again with the cash forecasting, because you know that you don't want to default with any bank payments, you don't want to default with any interest payments, and that will be very helpful to have all of the assets and liabilities figured out. I know it was a lot of information to absorb, so we'll go back to Ruhel. Ruhel can summarize the major key red flags for the liability side before we begin into the equity section and try to wrap up the session with a few important ratios that we look at.
Thank you for that, Kiran. Little fun fact, when you're talking about unclaimed wages, just to throw it out there, New York State currently has 19 billion in unclaimed wages, and that number is growing daily. So if you or anybody that you know, if the only thing you need is your, first name, last name, and your address, and you should be able to check if there's any funds there for you and yourselves. Uh, Now back to the liability related red flags. So red flags, liability is definitely a concern. Obviously, that's what the business owes. You owe obviously vendors, if you have debts, you know. So this is something that we definitely want you to focus on at all times. We generally send a weekly AP report that shows your AP at a glance. It shows how much money is owed to vendors, what are the terms, how many days were past due, so on and so forth, right? So making sure that that accounts payable balance is always at a, pretty much not too high or it's not too extensive is definitely a requirement. Making sure that you stay within terms is definitely something that we try to do as much as possible. So in order to do that, obviously looking at the AP report on a weekly basis is definitely a requirement. Also maintaining it to a, much attainable balances is something that has to be done. And for that, you would obviously have to make sure that you have a cash forecasting, you're paying vendors when the invoices are coming in, staying within terms, etc. The second one is obviously accrued expenses. Accrued expenses are essentially for any invoice or any expense that we know you will incur. We have an idea. It could have been a repair that was done at the restaurant that you know you're expecting a large invoice for. However, the vendor has not sent you that invoice. So we generally accrue for it, given the fact that the work had already occurred at the restaurant, the repair has already been done. However, we have yet to see that invoice coming. IRS generally lets us hold something in accrued expense for year end until March 15th deadline. So if we don't have that invoice prior to that March 15th deadline, then we cannot show that expense for that prior year. So making sure that any expenses that are out there, we definitely want to get those in so we can make sure that we can get the proper expenses shown in the prior year for tax return purposes. And also you want to make sure that it's not also an increasing balance, right? You should not have many accrued expenses out there. You should not be invoices out there that you have yet to receive. So just making sure that the communication has been done with the vendor. So you're getting those expenses, those invoices real time. So then we can book the invoice and just be done with it. And last but not least is the long-term debt, right? Often because of cash crunch issues, you as operators, business owners, you're forced to take out a loan against the business or going to a bank and getting a high interest loan out of the bank. So, that should be like the last resort. Definitely these loans come with the high interest, like I mentioned. So just understanding what are the deals out there, perhaps speaking to a couple of lenders may be a good way too, as well, to assess the situation and making sure you're getting the most of it. Because a lot of the loans that you're receiving, whether from a third party institution like the banks or even a POS processor for that matter, right? What they're doing is they're taking their principal and interest at the time of the settlements. Most POSs do that, where they're taking 12 to 15% of your daily net sales, and of that amount, maybe 40% of it is going directly to interest, right? That really hampers cash flow. So although you may have the revenue that you want, but your bank balance will not reflect it because half of that settlement is going towards paying back old debt and interest. So just making sure planning for it and just forecasting ahead is definitely something that we should all do. And with that being said, I think that pretty much wraps up the red flags that we look for in liabilities.
Thank you so much, Ruhel, once again for summarizing red flags on liability. If you're still hanging in there, now we'll go in with the equity section. Equity will be much more smaller, but much more important from the business ownership point of view. Equity is anything that the contributions were made from your investors, from your friends and family, maybe through Series A, maybe through crowdfunding, any preferred shares, anything and everything raised as capital contributions are recorded under equity sections. This will be recorded as and when you raise money along with the shareholder agreement that you do with these investors. So we know if there are any other rights, any preferential rights over the dividends, if there are any dividend rules that are set up or attached to these investors. One common software that we have seen a lot of our clients use is Carta. And if you are already in a place where you are already thinking about expansion or maybe going for the next round of funding or raising funds, at Paperchase, we do have an additional offering that is the FP&A service. Dimitri, our colleague based out of LA, leads this division, and let me tell you, he's absolutely fantastic. He can help you prepare the investor deck, investor pitches, as well as also connect you to right people in this industry that can be interested to invest in the businesses, mostly the institutional investors and big restaurant groups that are always looking to expand. The second key component under equity section is the retained earnings. A lot of you might have questioned what does retained earning mean or what is this number lying on my balance sheet, because it doesn't change very often. Retained earning, also called as undistributed profit, earned surplus, or retained profit, is the portion of money that you have chose to keep in the business and not distributed. Let's say all of my friends and family invested $3 million, and this year I made a net income of 198K till now in these 9 months of operation. I can either choose to distribute it to them and give them the benefit of investing as a reward, Or I can choose to keep a portion of that or entire portion in the business for future needs rather than going back to them for raising another round of funding. So again, it's a very specific business decision, and it depends on the agreement that you have with your existing investors. Any undistributed profit gets back added to the retained earning. So at the end of year, and this is a very common question that we get because once your tax returns are filed, this adjustment is taken care of. Any retained portion of profits that you are not distributing to your owners or your investors gets clubbed into retained earning, and there is a fresh start for your net income or net loss depending on how the business goes. Having a net loss here also indicates the need to look at your cash and bank balances and forecast, because if you are running low on your cash, or if you are in a month that is particularly not the best for you, can also come in handy with the cash forecasting or budgeting that we do at Paperchase. This was a little bit about some of my learnings about the balance sheet. Now, we would like to go to some of the key ratios that can do a quick health check if you don't have a time to analyze all of these in such detail. So these are some quick metrics. Again, you can calculate it at your end, or you can take help from the account handlers or team that you work with. Some of the key ratios that we look at for solvency. Solvency is basically the measure of how liquid or how much more the business can take on. So debt ratio, debt to equity ratio that we briefly spoke about, that how much more debt can I take in the business. Interest coverage ratio will give you a matrix of how much more cash you have to cover the interest in future periods. Liquidity ratio gives you a quick scan of the business in terms of liquidity. This is basically all your current assets divided by your current liability. And what it indicates is that how much current assets do you have that are able to pay your bills for the next 12 months. Typically, higher the current ratio is better, because that gives you a fair sense of relax that, okay, I do not need to get on cash funding right now, or I do not need to cut back on my expenses right away. Another kind of ratios that we use is the profitability ratio, where we look at the profit margins of how well the business is doing, wherein your EBITDA will come in handy, your four-wall EBITDA will come in handy, your net profit might come in handy, your PAT might come in handy. So these are some that we look at. And then there is return on equity, which is tied back to how much equity was invested to earn this return. Another ratios that we use here is return on asset ratio, because if it's a fine dining restaurant, again, you will have much more investment on the asset and non-current side of the business, which is much more uh, which is much more non-current fixed, that can derive your returns. And then final leg is the activity ratios. Michelle, if you could move to the next slide. Activity ratio basically that we use most commonly are the asset turnover and receivables turnover, that we also refer to as DSO, which basically indicates of how long is the receivables conversion period to cash, how long are your customers taking to pay you. So those were a few quick ratios that we use to do a health check of business. It's just like checking the pulse when a doctor comes in. So these were a few things that we wanted to share today. And I hand it over back to Caroline and Michelle.
Thank you both for sharing that. Thank you so much, Kieran, for walking us through the balance sheet. We're now going to open it up for any questions that our audience has. So if you have any questions, whether it be related to a balance sheet, your balance sheet in particular, or just in general restaurant finance questions, please go ahead and drop them in the chat or the Q&A box. You can also raise your hand and I can allow you to talk. We can do like a little, call-in thing. If nobody has any questions, we can also go into some frequently asked questions that we get. But I'll let you guys go ahead and give you a minute to answer, to go ahead and type in the question box. Awesome. We have a question from Raul. Retained earnings is basically basis basis in the company. I think he means basically interest in the company or ownership in the company. So do you want to just explain what retained earnings is for us?
Mhm. Basically, retained earning is the accumulated profit in the business that has not been distributed yet. That is an accumulation of all the years' profit that you have been making, all the losses that you have been making. And if you have not distributed it, let's say if earned $100 this year and I distributed 20 out of it, so 80 would be the retained earning on my balance sheet that is available for future use in the business or for reinvestment in the business. Does that answer your question, Paul?
Mm. And the key thing here is that it's always at that time or time frame that you're looking at, right? So you can look at your retained earnings as of 2023, December 31, or 2024, December 31. So at that time, you'll see how the business did and how much money or how much profit the business had generated that could have led to distributions, which was essentially not distributed.
Any other questions? Do we want to just run through a couple of the FAQs really quickly while people are typing their questions?
Yep, we could do that. And I would take a moment to thank everyone who's still with us. Okay, the first one that I see is what are the best practices for utilizing event platform reports to maintain and reconcile deposit balance? Again, this will be very, very important because we are in the restaurant and hospitality industry. Imagine one customer coming in who already made a deposit of $1,000 and we are not sure if he made the $1,000 deposit or not. So having this balances up to date, maybe using an event platform, let's say Triple Seat, having it punched there or having it through your accounting team doesn't matter, doing it in Excel or a software, but you should basically have a record of each and every deposit that was made, each and every redemption that was made, and we do honor the money that they have put in with the trust, and we do honor the reservation because I wouldn't want to be in a restaurant which I made a reservation and they don't have place for me on my birthday. That would really cut the tie off for entire life. So honoring this is a major part of customer relationship as well as accounting to make sure that we have that honored and we do keep the space for them separately.
We have a follow-up question from Raul. So in this example, you gave the $80 and that goes to retained earnings. The $20 I decide to keep as profit, what does that get categorized as?
For example, you gave 80 goes to retained earnings. So 20 would be recorded as a distribution to your investor. It can be in form of a dividend, or you could have it as net distribution that ultimately reflects on their K2s in the balance sheet that we file. And that's basically their income, which they'll file as their income and in their tax return, and they pay part of that taxes on that.
Thank you so much, Raul. Do you want to chat a little bit about debit balances, Kieran?
Yep. Explaining debit balances are not necessarily credits in AP ledger to the client, which we basically touched base on while we were reviewing the AP aging. So there could be multiple reasons of having a debit balance on your AP. One of them can be missing invoice backup. One of them can be actual credit that we have from that vendor. We'll have to do the vendor reconciliation process to make sure why there is a debit balance because typically it is a credit nature of that account itself. So again, there can be various reasons having this vendor reconciliations done, and this is what one of our key strength is at Paperchase because we have so many AP analysts that are very thorough. If they have to follow up on emails, if they have to follow up on calls, go meet the vendor, they can do that and make sure that the balance is up to date and there are no issues with ordering or getting the orders in time. Next question that I see on screen is how to identify intercompany GLs if it has been paid or taken from that location. The one word answer to this would be the intercompany reconciliations. Usually, if you operate in multiple location or multiple branches, there will be definitely, unless you make a very conscious effort, there will be movement of a few food items, there will be movement of few labor, because if you are organizing a big event, you need to move and take help from the people that are experienced and trained. So having all of that intercompany movement is not a problem. You just need to make sure that the intercompany balances are reconciled. And if accordingly you need to to transfer any cash balances, we could also do the movement in bank accordingly. And then fourth one, I should send this back question to the audience because we already covered that why party deposits cannot be booked as revenue and it should be booked as a liability. Again, if you heard me, it was based on the US GAAP principle of revenue recognition. Anything that is not 100% sure, right now you cannot record it as revenue till the time you get that money in, till the time you have that event done, till the time you have that reservation honored. Okay.
Awesome. If there are no further
No
questions, or if you are feeling just too shy to ask right now, you can always email us after this session. We're actually going to send around a recording of the session plus the PPT that we presented, and it will be available on our YouTube. We would love for you to send this session to any friends, any colleagues who you think could find this useful.